Welcome to a special edition of Market Movers. I'm Jim Urio. Once a month, we like to look back at some of the trade examples we've given in the past and go over the when, the what, the why, and most importantly, what we learned. Now, on a weekly basis, Market Movers tries to provide market analysis, insights, and specific trade examples to help gauge current market conditions. Looking back in November, December, what were the biggest drivers in the market?
Oh, gosh, Jim, pick one of any of these. Brexit, the Fed, G20. How about trade wars with China?
Hey, man, all
and
of it,
ES
right?
volatility, too,
it was
I think
a crazy
was
month. There's no question about it. So let's talk about the trade.
So we had a lot to choose from, as I
Yes.
mentioned, Jim. But specifically, on November 20th, we did a Fed review show. If one was to be done, in fact, after the jury was kind of moving out on the Fed, so to speak. And the expression I put on was to buy the January ZN in a 118.5, 119 call spread format for 12 ticks. The trade risk 180 at the time to make potential 320.
Nice.
And so, we had this expiration of December 21st, by the way, on that trade. And so, a trade expression. And it was like, looking at the Fed and looking at how much the ZN had rallied in that kind of double bottom that it had in October. And that was really why. I looked at this double bottom in the ZN, Jim, in October and November. And it looked like the ZN wanted to race up to chase August highs, even though it already moved quite a bit off that bottom. And I have a lot of long, say, ES-related positions, whether it's stocks or ES itself. So I wanted to hedge it against something, right? And the ZN is long ZN is a good way to hedge typically against, say, long equity. So what happens? It happened over the course of the following weeks was that, number one, the call spread got completely filled out with respect to not going all the way to expiration, but the call spread was filled from about an 80% or so level when you look at where the pricing went on the ZN. So that was great.
Yeah.
So that's also something too, as a lesson was
Do you cover if something gets 80-85% and you still have a week, 2 weeks
given
left?
this volatile market and given that at the time there was quite a bit of time left in that expression, yes, because of the fact that I'm happy to move on to something else if you're 80 or 85% right in that case, which
that
we
makes
were.
perfect sense to me.
And so what this told me though too, Jim, is as even the ZN had rallied prior to putting on that expression, markets in volatile environments and frenzy and panic do overshoot things sometimes. So even though the trade, or the chart rather, may look extended, a trade example where you still want to follow that trend is still, I think, a fair kind of positioning when you look to hedge some of the other things you may have in your portfolio.
I like that. Now, the one I'm going to talk about did not have quite a happy ending, but it was a totally different theoretical strategy as well. On our November 14th show, we did a show about Brexit. Now, there was a vote coming up in Brexit that could have gone either way. Now, saying that now, it almost seems like a joke because it seems like there's a vote coming up in Brexit almost every week now. But at that particular time, it seemed very important. Now, the pound had been demolished over the previous months and was trading about a 130 level or so. So I looked at buying the November week 4 132, 134 call spread for 37 ticks. It risked $210 to make a potential 1040. Why I put this on? Because even though it didn't really hedge anything I had, it did seem like a potential for a black swan event. And anytime a market gets moved too far in one direction, it seems like a potential is for a violent snapback. It didn't happen. If you look at the pricing in retrospect, $200 to make $1,000, but basically 5 to 1. The market is telling you that this isn't very likely. But if something happens, it could happen. You could make some money on that. It didn't work out. I did have peace of mind going into that vote, knowing if something went haywire that I was covered.
True, and to the point we just made on the ZN expression of mine, when the markets are anxious, when they're in this period where psychologically they're just all over the map, when you have an expression like you did where that risk reward is so kind of unbalanced, you can put on an expression like that and manage it too if you do get a bounce or a movement somewhere.
I really like that. Markets have been really, really volatile. When you see something like that seems relatively cheap, that's probably what attracts
And they'll continue to be too. I mean, in other asset classes, if it's not in one asset class, it could certainly be another. Plus the futures liquidity, the 24/7 markets that we basically have these days, great ways to express a bullish or bearish position.
Like it. Thanks for joining us in this special edition of Market Movers. I'm Jim Urio, where we're hoping to make you a better trader.